Hello everyone and welcome to the Margin of Safety Investors channel. Today we're diving into Celsius Holdings, the fast-growing company behind Celsius energy drinks, who has grown more and more popular. Celsius, founded 20 years ago, has gained attention for its unique blend of ingredients designed to boost metabolism and burn calories, positioning itself as a health-conscious alternative in the competitive energy drink market. We'll take a closer look at its business model, financials, and what sets it apart from competitors. But before we dive in, let's go over an important part, the disclaimer. Please note that the information provided in this video is for discussion and educational purposes only. It should not be considered financial or investment advice. Make sure to read the full disclaimer. Now let's take a closer look at Celsius. In recent years, Celsius Holdings has experienced tremendous growth, both in revenue and market presence. As seen in this chart, their sales have skyrocketed from just $14.6 million in 2014 to an impressive $1.3 billion last year, with a remarkable compound annual growth rate of 7%. A major factor contributing to this growth was their strategic partnership with PepsiCo 2 years ago, which not only expanded their reach, but also enhanced their distribution capabilities. This partnership is crucial as PepsiCo's vast global distribution network allows Celsius to access more markets and secure greater shelf space in key retailers. Shelf space is critical in the beverage industry. Having prominent placement at eye level in stores can significantly impact a brand's sales, as it directly influences consumer purchasing decisions. By leveraging PepsiCo's relationships with retailers, Celsius can ensure its products are more visible and accessible to consumers, which is a vital component of its growth strategy. Additionally, PepsiCo took an 8.5% equity stake in Celsius, aligning their interest with Celsius's success. This equity stake not only strengthens the partnership, but also shows Pepsi's confidence in Celsius' long-term growth potential. With an increasing focus on health-conscious consumers and innovative marketing, Celsius continues to capture new market share, especially in the functional beverage space. This level of growth is rare, and it's one of the reasons the company stands out in the highly competitive energy drink industry. Now let's dive into the numbers. Celsius Holdings had an outstanding last year, with total revenue growing by an impressive 102% year over year, reaching $1.3 billion. North America, where Celsius has the strongest foothold, accounted for 95% of the company's sales, contributing $1.26 billion. International sales also saw significant growth, rising by 52%, although they still make up a smaller portion of total revenue. The company also managed to significantly expand its profitability. Gross margins increased by 660 basis points, reaching 48%, while the adjusted EBITDA margin jumped from 10.9% 2 years ago to 22.4% last year, showcasing much stronger operating efficiency as the company scales. As John Fieldly, the CEO of Celsius, stated in the annual presentation, Celsius had a stellar 2023 fourth quarter, the best earnings year in our company's history. We have achieved nearly complete distribution coverage in the United States, topping 98% ACV, which is a major achievement, putting our products in reach of more consumers and more consumption occasions with greater flavors and size options than ever before. Celsius becoming the first company to break the 10-share barrier in more than a decade is another testament to our impressive share gains in 2023. This statement from the CEO underscores just how crucial the company's increased distribution has been to their growth. Achieving 98% ACV in the U.S. is a remarkable feat that not only increases their reach, but also ensures that Celsius is available to more consumers in more places. The fact that they broke the 10-share barrier further highlights their growing dominance in the energy drink sector. In Q2 of 2024, Celsius continued to demonstrate strong performance, with total revenue growing 23% year over year to $402 million. North America, which by far remains the company's largest market, accounted for $382 million in sales, a 23% increase from Q2 of 2023. International sales grew at an even faster pace, rising by 30% year over year to $19.6 million. The company's profitability also continued to improve, with gross margins expanding by 320 basis points to 52%, reflecting better operational efficiency and lower costs. Adjusted EBITDA increased by 29% to $100 million, with margins improving by 100 basis points to 25%. As CEO John Feely mentioned in the latest quarterly update, sales of Celsius began in the UK and Ireland in the second quarter, and we're following our international expansion playbook to see product launch with a key retailer and grow international launch. Similar to Canada, our progress in these new global markets is exceeding initial expectations. Our plans for Australia, New Zealand, and France remain on track for launches later in the year, and we're expected to continue to grow our global growth strategy this year by pursuing favorable distribution partnerships in opportunistic energy drink markets. Gross profit margins in the first 6 months were approximately 51.6% of revenue, as compared to approximately 46.6% for the prior year period. The improvement in gross profit margin in the first half of 2024 is attributable to favorable freight and raw material costs. While Celsius continues to deliver impressive financial performance, with strong revenue growth and expanding margins, the recent decline in the stock price can be attributed more to valuation concerns than to operational weaknesses. Earlier in 2024, Celsius was trading at a forward EV sales multiple of 16, which was very high by historical standards. This lofty valuation, combined with a natural slowdown in growth rates as Celsius approaches full distribution in the U.S., has contributed to the recent pullback in the stock price. Celsius now trades at 5.7 EV sales, down from 16 earlier in 2024, aligning more closely with competitors like Monster and Coca-Cola. The lower multiple reflects a natural adjustment as growth moderates. As we can see, Celsius's valuation multiples have come down significantly. The lower multiple reflects a natural adjustment as growth moderates. This correction is not unexpected, as high-growth companies like Celsius tend to see their multiples compress once they reach saturation in their primary markets. With full U.S. distribution largely achieved, it's natural for growth to moderate. Nevertheless, the company's ongoing international expansion efforts and operational improvements continue to be key drivers for its long-term growth story. However, the slowing sales are expected to be further dampened by the inventory correction from PepsiCo. Earlier in 2024, PepsiCo ordered more inventory than necessary, temporarily boosting Celsius revenue. It's important to note that Celsius books its revenue when delivering inventory to PepsiCo, not when consumers buy the products. To correct the overstock situation, PepsiCo reduced its orders significantly in Q3 2024, expecting to order $120 million less compared to the same period last year. Although actual sales to consumers remained up 10%, the reduced orders will likely have a substantial negative impact on Celsius' Q3 financial results. This highlights the temporary nature of the issue. Once inventory levels normalize, we could see a recovery in the coming quarters. Looking at the next 12 months, Celsius is now trading at a 4.7 EV sales multiple, which is lower than Monster at 6.4 and Cola at 7, but still higher than PepsiCo at 2.9 and Keurig Dr. Pepper at 3.9. This shift reflects a more moderate valuation as the company's growth trajectory begins to normalize, with consensus expecting Celsius to achieve 17.9% sales growth over the next 12 months, significantly higher than peers like Monster at 8.1% and Coke at 4.9%. It's clear why the market may justify a premium multiple for Celsius. This higher growth trajectory supports the argument that Celsius deserves to trade at a higher valuation compared to more established and slower-growing competitors in the beverage industry. While the U.S. market is becoming more saturated, Celsius has significant room for expansion internationally, particularly in Europe and Asia, providing additional growth opportunities in the coming years. Celsius's 2024 global expansion highlights significant growth potential outside the U.S. With sales already initiated in Canada, the UK, and Ireland earlier this year, the company plans to enter key markets like Australia, New Zealand, and France in the second half of 2024. This global push underscores the company's focus on tapping into international demand, providing plenty of room for further expansion and diversification. While Celsius commands a premium multiple on EV sales due to its strong sales growth outlook, It's important to also look at profitability. When we shift to EV/EBITDA multiples, Celsius still trades at a higher valuation compared to peers. Currently, Celsius trades at 28.1, looking at trailing 12 months and 21.4 for next 12 months, surpassing competitors like Monster and Coca-Cola. This suggests that the market continues to price in not only strong revenue growth, but also robust expectations for profitability and margin expansion as the company scales. This chart highlights the significant turnaround in Celsius's operating margin before D&A, which surged to 22.7% in 2024 after years of negative or low margins. In contrast, Monster Beverage has maintained consistently higher margins, although it has experienced some decline in recent years. The improvement in Celsius's profitability is a key factor in justifying its higher multiples, as the company rapidly scales and improves operating efficiency. However, one could question whether the decline in Monster's margins is related to the increased competition in the energy drink market over the last few years, compared to its more stable period between 2015 and 2020. Going forward, the industry may need to accept heightened competition, which could result in more price-based strategies such as promotions, marketing, and discounts. This in turn could lead to lower overall margins for both established players like Monster as newer entrants like Celsius reach scale. The equity analysts have varying price targets for Celsius holdings, reflecting different outlooks on the stock's near-term performance. Morgan Stanley has a target price of 50, maintaining an equal weight rating. They cite the lack of a near-term catalyst and note, "We don't see a catalyst until its trends and scanner data inflect positively." BNP Paribas is more optimistic with a target price of 55 and maintains an outperform rating, basing their evaluation on 7 times sales. Jefferies has set a target price of 48, expressing that while they were too optimistic in the short term, they believe the stock is still undervalued. They state, "We don't think the slowdown is structural, but we were too optimistic near term." Implied market share tells you Celsius shares are still too cheap. Reiterate buy. Roth MKM has the lowest target of 43, highlighting the impact of a recent inventory drawdown by PepsiCo. But they remain confident that with the inventory issue now balanced, revenue growth should help lift the stock price moving forward. Each firm is closely watching the company's progress, with some highlighting short-term challenges, while others focus on its longer-term potential. Looking at the consensus forecast on the left, total revenues for 2026 are expected to reach $1.96 billion with an EBITDA margin of 22.6% and a multiple of 17.6. On the right, we have a more optimistic forecast that believes in stronger international expansion, projecting higher revenues of $2.08 billion by 2026 with a higher margin of 25%. The multiple for this scenario comes in slightly lower at 14.9 due to the expected margin improvement and growth. Now, while it's clear that the pricing is not as demanding as it was 7 months ago when the stock was trading at much higher multiples, I lean to it appearing more or less fairly priced at this point, given the current uncertainties around growth and margin expansion. Therefore, I continue to keep it on my watch list to see how these forecasts evolve. What do you guys think? Are the consensus estimates too optimistic or pessimistic regarding growth and margins? Let me know in the comments. And don't forget to subscribe for more deep dives. And please remember, this video is solely for educational purposes. It is not investment advice, so make sure to do your own research before making any decisions.